thank you all for watching this 30-minute conversation between myself. I'm Tom Harvey, SVP of Product Management at Risilience, a climate and environmental risk analytics company. Today I'm joined with Chris Brown. I'll let Chris introduce himself in a second, but Vice President of the ESG division in Synthomer. We're here today to talk about from compliance to competitive advantage and how Synthomer are embedding their climate resilience into business strategy. So moving beyond just regulatory tick box, regulatory compliance into actually making business decisions and overall enhancing the resilience of Synthomer. So I'm delighted to be with you today. And Chris, I'll hand over to you to give a brief introduction, if that's all right. And maybe we can start with a question just for the audience to give a little bit of context on Synthomer, what the company does, and what you tell us a little bit more about the company.
Yeah, no problem. Thanks, Tom. Great to be here and share some insights from the work that Synthomer was able to do with Risilience. So to set the scene, Synthomer is a global specialty chemicals company. We manufacture polymers that go into a wide range of applications, so things like coatings and adhesives, construction materials, healthcare products like examination gloves. From a sustainability perspective, we're focused on providing our customers with solutions to their challenges, rather than just focusing on corporate targets. So, for example, we look to increase performance by extended lifetime through the use of our products. We can reduce raw material use by enabling recyclability. We're constantly looking to reduce the carbon footprint of our products, ways to reduce customer energy use by enabling lower temperature operations, and reducing waste through lightweighting. And from a climate perspective, I guess we're also at the heart of that challenge. Like many industrial companies similar to ourselves, we operate energy and process intensive assets. We have quite a substantial global footprint, and we serve customers and end markets who are themselves under increasing pressure to decarbonize. So that I think is a quick overview. So yeah, I'll leave it there, Tom.
Yeah, no, that's really helpful. I think it's really important and useful context for framing the discussion going forwards. Obviously, the creation of polymers, specific kind of plastics, it's a really quite contentious topic, contentious area within the climate science space. There is a huge demand and need and demand for the types of products, and oftentimes they are adding substantial value. So I think you're at a really interesting position in the market, and so it's going to be hopefully a good discussion. So I wanted to start off. So obviously, climate risk assessment has been around for a while. The TCFD framework has been around for a while. Maybe could you talk a little bit about your journey to date as a company in terms of the climate risk assessment process that you went through, and that you're going on up until the point you sort of started working with Risilience?
Yeah, sure. So I joined Synthomer about 3.5 years ago now. Been involved in sustainability for many years, and gone through TCFD processes before. But when I joined Synthomer, I guess our approach was relatively typical of most companies a few years ago. We were aligned with frameworks like TCFD. We had good visibility on our emissions, particularly scope 1 and 2, less so on scope 3. We had a reasonable understanding of some, but not all of the types of risks we faced. And we had emission reduction initiatives underway, but it was predominantly qualitative. We could describe risks, but we probably couldn't answer questions like, what does that mean financially? Where are we really most exposed? And where do we really need to prioritize action, and when? So we recognize climate risk, but it wasn't embedded into core business decisions. And that was really sort of the journey for us, moving from describing climate risk to quantifying it and beginning to manage it like any other financial risk. And that was the real sort of question we were asking ourselves. How do we do that, and who can we work with to help us on that journey?
Yeah. Yeah, and was there sort of a light bulb moment or a driving force moment that got you to go, okay, actually, rather than doing sort of a more qualitative assessment, we do need to start quantifying this? Was there a sort of a trigger point that made you make that change?
Yeah, I guess again there were three main triggers. The first was we have two sites in the EU. So the first was about financial materiality, predominantly related to those two sites, but not only those two sites. It was around carbon pricing, the impact of carbon prices. So this isn't a theoretical risk. It's real, and it's a growing cost for parts of our business. And we realised if we don't act, we expect to see this impact our competitiveness. And again, particularly at two sites in the EU, but then looking at what's the potential risk broader than that. Second, it was about external expectations. So stakeholders, such as investors and regulators, increasingly expect quantified disclosures, including an understanding of how climate may financially impact the business, not just a vague narrative that companies were able to push out for TCFD in years gone by. And third, it was really around, excuse me, the internal need. So we needed better tools to answer practical questions and support decisions. So questions like, where do we invest? Which assets are most at risk? And how resilient is our business under different transition scenarios? So again, it was really moving to how do we respond to some of these financial questions? So moving from a compliance mindset, a tick box mindset, if you will, to a decision-focused approach.
Yeah. Yeah. Okay, that makes sense. And I think that's very a shared experience across a number of our clients. That sort of the regulatory pressure is clearly there, although it's slightly lessened now with the kind of delays and slight rollbacks in various jurisdictions. But the carbon price is starting to ratchet up across various things. We're seeing the introduction of carbon border adjustment mechanisms. We're seeing, we are seeing changing structural patterns, whether it's the energy transition that is underway. And so some of the risks that were somewhat theoretical 4 or 5 years ago and haven't, they were impacting pockets of the market and pockets of the economy are becoming real for companies. And so I think that's a meaningful trigger to start thinking about this. And with everything, yes, we have sustainability goals that we want to be looking towards, but understanding the risk and therefore the investment trade-off is pretty critical. And that's where sort of a quantification of that financial risk becomes a little bit more important.
And I think just to build on that, actually, one of the things that we know from, and most companies again will know, if you're involved in innovation, change takes time. So whilst some of the carbon pricing might not feel like it's in place today, by the time you've understood risks and started to build a strategy to address those risks, it takes time. So the sooner you start, the better placed you're going to be for addressing this going forward, because these are probably no regrets actions at the end of the day.
Yeah, for sure. I think we'd probably get into some of those mitigations and some of the decision making that you're able to do off the back of the climate risk assessment. Maybe just to give people a view of the sort of journey, if that's not an overused word, the journey that you guys have been on. So, can you talk a little bit about the process that you went on in terms of data collection? How did you manage to get that? What was the analysis? What was the sort of the process that you went through to try and quantify that financial risk, and any challenges or surprises that you came across as you went through that process?
Yeah, absolutely. So working with Risilience, the key step was building a digital twin of the business that we then overlaid that data upon. So we mapped our production processes, not just our own, but also looking at joint ventures, third-party manufacturers. So being mindful wherever there might be potential for business interruption in that processing space. Looking at supply chain hubs, storage facilities that would be sort of rented by ourselves, looking across all of the geographies, and then overlaying the emissions profiles related to as much as we could, as much of those things as possible. So with a team that involved procurement and finance and operations particularly, really putting in a lot of time and effort to do that, and then linking it to the financials. So the financial team or the finance team, then I guess slightly outside of their usual comfort zone, we're then having to think, okay, how do we earn our money? We're really map all those financial flows across the organization onto this digital twin, and from there we could start to model things like carbon pricing scenarios. We could start to model the physical risks associated with flooding, be that riverine or coastal or flash floods, temperature change, water stress, windstorms. Windstorms was interesting because it seemed like that wasn't really relevant up until just before we started this work. There was actually hurricanes for the first time at 2 of our sites in the US. So that sort of opened our eyes to, okay, you may not have had a risk in the past, but things can change going forward. So having that forward-looking information around physical risk was really valuable. And then transition risk, so really looking at things related to regulatory change, consumer sentiment, technology changes, investor sentiment, and how things might affect reputation. And obviously some of these models are more mature, more well-formed than others, but it's really to give us an indication of the direction of travel for some things like reputation, because that's quite difficult. But again, it's something we've got to be cognizant of. But the really important point is all of this connected back to financial outcomes. So instead of abstract climate scenarios, we're now looking at potential cost. We're now looking at potential revenue impacts, where we're looking at what are the implications on capital planning. So instead of asking what might happen in these abstract terms, we're really beginning to ask questions around what does that mean for the business financially. And that was a huge step forward. I think that was the real sort of eureka moment, where it moved from, okay, this is tick box, to now, okay, we're starting to have these scenarios where we can think, what does that mean to the business, and how do we react to that?
Yep. No, that makes absolute sense. And I think that's often the case is when you start seeing your own financial projections that the finance team are fairly comfortable, and then the adjustments from that, from the climate risk, and it starts to become quite real and therefore more actionable. Could you talk just how you're sort of taking this and embedding it across the different parts of the organization, maybe just the different touch points? You mentioned some of those, but how are you engaging with others across the business? What departments and how are they starting to engage in the analytics?
Yeah, so rather than looking to sort of do this as an isolated piece of work, it was saying, okay, so climate risk is one of many risks that we have to understand and manage. So how do we just understand, identify and manage risk across the organization? So we have an enterprise risk management framework that obviously each team is asked to look at the risks. So this work allowed me to then speak with operations teams. It allowed me to speak with procurement, supply chain, again, to make sure that the risks that they're identifying are similar, or looking at the risks that are coming out of this piece of work. So we had to go away and sense check what came out of the work with Risilience, needed to be sense checked at a local level, but it was really to play it through into the enterprise risk management framework. So where you've got a real process around identifying what's your inherent risk, your residual risk through the actions you're taking, what's your target level of risk, what's your risk appetite around this. So are you already doing enough, or do you need to do more? And then that connects back all the way through the executive risk committee back through into the audit committee. So working very closely, obviously, with the head of risk and their risk team, and ultimately it feeds through into strategic planning and capital allocation again. So it's really connecting it alongside those other core business risks, using the same language, so financial impact, risk exposure, return on investment. So we're not having to bring a different vocabulary on the topic of risk to people that are dealing with it in a certain way already within the business. And again, that was a key shift. So it's no longer a separate agenda. It's fundamentally part of how we make decisions around risk, and makes it much more relevant to the business.
Yep. Yeah, no, I think that's absolutely fundamental. I think that enterprise risk discipline, so Risilience as an organization grew out of the Centre for Risk Studies at the University of Cambridge. And we saw sort of 15, 20 years ago the need to start to apply some more rigorous scenario modeling to all sorts of risk, whether it's financial risk, whether it's credit risk, whether it's geopolitical risk, etc. And I think you can see the rollout of that from enterprise risk over the course of the last decade or so. More and more companies are starting to really stress test their business against these different externalities, and there's a lot going on at the moment that is posing a material financial risk to companies, and I think climate change is just one of those, and the changes that come with it is just another sort of lens that companies need to consider. And so being able to use the same sorts of tools around financial quantification that those other the way those other risks are managed, I think is pretty critical.
I think the key point there, Tom, was you used the word material as well. So I think there's always been a tension between what a sustainability team might view as material and what the rest of the business classes as material. So essentially, we're using the same tool now. So there's no debate. So if something is going to come out as material, then it's treated as material the same way as anything else. And if it's not, then fine. Okay, it's not like you forget about it, but it's really been a great leveler to help the various teams view and agree on what is material to our business, and therefore what is it we need to do. How do we escalate that through the governance processes in the organisation and deal with these things appropriately? Yeah,
no, exactly. Maybe to bring it to life a little bit, it's provide a helpful lens. Is there some maybe one or two practical examples that you can bring to life in terms of the climate risk assessment and how that's directly influenced decisions? Maybe what are some of those material risks, and therefore what are you now doing to mitigate them that you might not have been doing before?
Yeah, of course. So maybe I'll give two quick examples to try and bring that to life. So the first, I'll go back to the EU ETS piece, but it's because that's real. So as mentioned, two of our sites are captured under the EU emissions trading scheme, and we know that the free allowances that are allocated are declining and may ultimately reach zero. So there's a very clear trajectory of rising cost. And we'll see this play out in other jurisdictions that bring in carbon pricing. So the modelling allowed us to quantify sort of the cost of doing nothing, the future cost of emissions versus the cost and benefit of investing in emissions reduction. And then also, was slightly separate to the work with Risilience, we then start to say, okay, why would we do that? Is that going to allow us to offer different level of service to our customers? Can we offer lower carbon products as a consequence of really prioritising at those two sites? So it prompted some more business discussions around it, but it also feeds sort of directly into CapEx decisions. So it helps us sort of look at decarbonisation projects, not just about hitting targets, but from a real sort of commercial focus and a capital allocation focus. And that prompted a lot of challenge around where are we just spending our money? Are we getting the biggest bang for our buck? in terms of the CapEx decisions we're doing to essentially try and achieve a science-based target? Or can we be smarter in terms of how we invest to deliver better solutions for our customers and more appropriately use that money? So it's about avoiding future cost exposure and protecting our business margins. And again, that's a very different conversation internally to just chasing after a corporate target. The second example is related to physical risk and business continuity planning. So every site has a business continuity plan, but what we hadn't done is look at where climate sat within that, and we hadn't stress tested that. So with a footprint across Europe, Asia, the US, we're exposed to very different climate hazards. And I'd mentioned the couple of hurricanes at sites in the US. We just had some really cold winters over in the US with extraordinarily sort of freezing conditions. There's heat stress in parts of Asia and certain flood risks identified in parts of Northern Europe through the modelling. So the modelling started to give us clarity on which sites are most exposed, how those risks, more importantly, could evolve. So we see things that are happening now, and we remember things that have happened in the past. But it started to give us an idea of, okay, what's that evolution of risk going to look like? And again, if you come back to capital allocation, if you're going to invest in significant change at an industrial site, you're putting in pieces of kit that might last 20, 30, 40 years, then you want some degree of certainty that you're investing in the right place physically. So giving us this lens to look through was really helpful about what might those future issues be going forward. But we also sense check these risks at the local level to determine if there'd been any local action. So some of the flooding risks that have been identified, there've been local action taken in Czech Republic as an example to mitigate those flood risks. But it allowed us to go and ask those more searching questions at the local level to determine if those risks were being experienced, examine our current approach to managing and mitigating the risks, and whether our business continuity plans were therefore robust enough. And if they weren't, then how do we move forward in terms of strengthening those? And again, allocating scarce resources. So it's moving from that general view of risk to very targeted, location-specific approach and deciding on where do we need to act first.
Yeah, no, I think that's a great answer. I think what we often find is that actually the problem is, companies are operating at such a scale. There's so many sites, there's so many locations, and the complexity of the climate change in terms of the physical risk, it is not a linear relationship between temperature going up and things like floods, even things like the heat waves, rainfall. It's a very complicated system. And in different pockets, you get exposed to different types of risks that may not make conventional sense. And so it's not until you're able to analyze the 5,000 locations that form the backbone of your operations and look at those each in turn against how are we going to be exposed to different events, different types of climate events at each of those, that you can start to know where to prioritize. And okay, there's an issue in one particular country with the flood risk, or what have you done there? Okay, in that case, actually you're aware of it, you've mitigated it, and so that's good. We can manage that risk. But there are other pockets where that may not have been the case. And certainly, we're seeing an increasing demand and issue around worker heat stress and worker productivity, and the need for places where you would never have HVAC systems in place, in distribution centers and various things being now needed to be a necessity. Otherwise, you're going to have some issues. So that's great. That's really helpful, Chris. I think that's a couple of very, very tangible examples of how the analytics has had real impact in terms of the business and the decision making that you're doing. I might want to just move the conversation forward and think about what's next. As you think about where do you want this to go in the coming few years? What do you think of How do you think your climate risk assessment, the adaptation planning might evolve, and embedding kind of metrics into your business model? What does the future look like for Synthomer?
I guess to start with, it's going to be about just continuing to execute on this and integrate more deeply. So yeah, I guess the priorities, as I see it, first, just continue to further embed into business planning and financial forecasting, making it part of how we plan the business long term. We have 5-year strategy, which is great, but if we're thinking about how we allocate capital, how we make longer term strategic plans, then yeah, this is becoming key in part of those processes. Second, it's about execution. We've got to deliver our scope 1 and 2 reduction projects and scale our decarbonisation efforts. So we've got to know where do we prioritise, and then think about what is our future going to look like as an organisation? Is it going to be shaped by the physical and transition risks out there? So again, it's really thinking about the portfolio of operations. Third, it's about increasing our focus on scope 3. For us, scope 3 is more than 85% of our footprint. It's much more complex. We're doing some great work with our procurement team and many of our suppliers, but it's absolutely critical and arguably greater value to work on scope 3 than scope 1 and 2 in terms of what we can then offer for our customers. So really getting closer to our suppliers and better understanding and engaging our customers on how business models will need to change to really focus on driving scope 3 reduction. It's also fourth, developing more product level insight, so greater understanding and communication of the climate benefits that we can deliver for our customers and link that more effectively to our commercial strategy, which means we've sort of got to understand what are the climate risks that our customers might be facing. So it's almost moving from thinking about ourselves to, okay, what are the challenges our customers face? And is that going to be wetter seasons, drier seasons? We experienced +40 summer in the UK and a -10 winter in the UK, so a 50-degree swing that typically we don't see. How is that going to affect not just our product, but the customer's end product as well? So this could give rise to some fantastic opportunity for innovation if we really deeply understand the climate challenges faced by customers and end markets. And finally, as mentioned before about business resilience, is continuing to build that resilience through our continuity planning. There's still uncertainty in models, there's still uncertainty in there, but we need to continue to look at the physical risk, the regulatory risk, how carbon pricing and markets will evolve, and build that into our business continuity planning. At the end of the day, it's about how do we build a genuinely competitive and resilient company moving forward. So I think those are the key points from my side, Tom, for what we're going to focus on coming next.
Yeah, it sounds like you're going to have a busy few months and years ahead. I think it's an interesting point around some of the opportunities, and we often, from a risk background, we obviously tend to look at the downside, but I think there's some really interesting opportunity, especially if you're looking at the specification of certain polymers and the need for enhanced, more resilient, more climate adaptive products. I think there's huge opportunity, which is pretty exciting, and I think there's a lot of innovation in your space, so lots of exciting things to come. Great. I think we are at the end of our half an hour. I probably could have asked you 100 more questions, Chris, but we'll leave it there. Thank you again for the time, and yeah, appreciate all the thoughts and comments, and we'll wrap it up there. Thanks very much.
Thanks, Tom.